Hey warriors, I hope you're all doing well. This is your friend Rahul Agarwal and I'm here back with another exciting new video for all of you. As you all know, September 2025 exams are around the corner and therefore ICA is playing its part keeping you ready for the upcoming examinations. As a part of its journey, ICA always has a practice to launch something called as the RTP, the Revision Test Series paper, and therefore today's discussion is going to be about looking into what kind of paper ICA has set for the RTP series and see if we have been able to cover all these in our batches or if there is anything new which ICA is trying to put down on the paper so that you can keep yourself ready for your September examinations. Now, this video is purely for discussing the paper and therefore we're not getting into solving the paper. The answers are already available in the paper. So we'll only be predominantly focusing on the MCQ series plus understanding what kind of questions they have been giving in the question paper. We are not solving the numbers in order to find the final solutions. You can always look into the solutions yourself. Second, for all those people who are watching this video along with me, I have a very small request. RTP is predominantly prepared for you. While I'm here giving you more of an understanding of why this RTP looks like it, what kind of solutions ICA is thinking about and everything, the primary responsibility of RTP lies with you. And therefore, my small request is before you watch this video, please go ahead, solve the RTP once from your side. See if you're already able to crack it off from your side and then watch this video in case you're not clear on what kind of adjustment ICA has given so that you can understand the adjustment from this video better. Yes, so please use this video as more of a reference point rather than relying on this video completely for discussing the RTP series. Please solve it from your end first and then see how we are going forward with that. Are we clear? Awesome. On that understanding, people, we're going to look into the RTP series. Let's see what kind of questions has been drafted. Take forward. I am looking at September 25. They have come and clarified that all circulars and notifications up to 28 February will be applicable for September exams. Let me give you a good news. For inter-syllabus, there is no new amendments which is happening from May 2025 examinations. So every one of you who has learned from a faculty for the May 2025 examinations are already fairly updated with your amendments for the September 25 exams. You don't need to read anything else. For those people who are for the first time writing September exams and have not gone for the classes relevant for September exams, probably because you are a student of November 24, Jan 25 and have not had the opportunity to write your exams in May 25. If you're looking out for amendments which are applicable for your exams from Jan 25 to September 25, then there is already videos available on the channel. People, please go ahead and look for the amendment series of the May 2025 and you should be able to use that as a reference point for September as well. Clear? Great. Let's look at the questions. So I say starting the first question by giving you a case study scenario. Let's first look at what is the question given by I say so that we understand the case scenario a little better. I'm looking at the questions. The question number 1 says, based on the facts of the given scenario, you're required to choose the most appropriate options for the following MCQ questions. How much amount would be taxable in respect of income earned by Mr. Manish for the let out property of residential and commercial units and under which head? This looks like something which is going to come from the amendment series, people. The current year amendment which comes and clarifies that when you have an income from house property, when you have a residential house property, even if you are in the business of letting out such residential house properties, you will still be taxable under the head income from house property. So it looks something related to that, but let's check what is happening. Next, I have question number 2 which says, what would be your answer to question number 1 if Manish is not a real estate developer and has a business of letting out of properties? So which means the business model is going to change. Let's see how we have to answer that question as well. Next, what would be the tax treatment of the vacant residential and commercial units held as stock in trade? So people, when it comes to income from house property, when you have some vacant properties, you have a time limit of 2 years from the end of the financial year in order to not be taxing it. So we have that as a timeline. Let's keep that in mind. Which of the life insurance policies would be exempt at the time of maturity proceeding? I think this is one question which is fairly coming in every RTPs nowadays. Since 2023's amendment, every RTP I've seen, every time there'll be a life insurance policy related question, while never has it come and appeared in the examinations, but for some reason, RTP series at least comes and says this is an important topic which you have to pay attention to. So yes, we're going to look into it. Point number 5 says, what would be the income taxable in the hands of Mr. Manish from the firm Zoko and Associates for the assessment year 25-26. They're asking for Manish, so partner's income is being requested for. Okay, I think, yeah, so therefore there are 5 MCQ questions. That's all the questions is. Let's look at the question. Let's look at the passage and let's see what is happening. Question number 1 says, Mr. Manish is a real estate developer. Okay, so I'm a real estate developer. His main business is construction, development and sale of residential house properties. Now here is where the challenge is. Notice, people, that when Mr. Manish is a real estate developer and his business is to only sell the properties, renting out of properties does not become his business, which means any income which he generates from renting out is always going to be income from house property. He developed a project named Asian Heaven, which was both residential and commercial units. He obtained a certificate of completion for the said project on 1st February 2023, not your previous year, previous year. He sold majority of the units. However, 15 residential units and 10 commercial units were not sold and are held as stock in trade. Yes, I'm going to hold these assets as stock in trade because I'm going to sell it in the future. To earn such income from such units, he has let out 10 residential and 5 units from 1st May 2024 at 15,000 rupees per month and 20,000 rupees per month. The expected rent of the properties are given as 14,000 rupees per month and 22,000 rupees per month for each commercial unit, all units being identical. Yes, I think with this we can already answer the question number 1 and question number 2. Notice the question number 1. The question number 1 says that Mr. Manish is a real estate developer and they're trying to understand what is the income which is going to be taxable for him. People, as a real estate developer, whether he owns a residential unit or a commercial unit, both are going to be under house property. There is nothing which is going to change in that as a model syllabus, and therefore let's look at how many properties did he let out. He had let out 10 residential house properties and 5 commercial house properties that too only from 1st May 2024. Yes, so I'm going to look at those properties, people. Looking at the rental properties, it is 15,000 rupees per month for residential and 20,000 rupees per month for commercial properties, whereas the expected rent is given as 14,000 and 22,000. People, rules of HP, when ER and ER is given, it is always whichever is higher. So from 15 to 14, 15 stands as my right answer. So I'm going to ignore this 10, I'm going to ignore this 5. I'm going to tell that yes, 15,000 per month is going to be the income which is going to be taxable for the residential units. Whereas when it comes to the commercial units, 22,000 looks more, and therefore that is what I'm going to take into consideration. So with that as a background, people, I think we can fairly answer this question. Let's look at this. What is going to happen? I have 15,000 rupees into how many properties are there? There are 10 residential properties, but these properties are going to be let out only for the period from 1st May, which means they're only going to be let out for 11 months. That becomes 16,50,000. But I am under income from house property, people. Income from house property then requires me to claim a 30% standard deduction, and therefore my residential units is going to be taxable for 11,55,000. Yes, so this becomes my first answer, 11,55,000 for my residential units. I hope this is clear for everyone. Yeah. Great. Let's look at the commercial properties. Commercial properties has 22,000, 22,000 being multiplied for 5 units, multiplied for 11 months. That gives me 12,10,000. In this 12,10,000, I'm going to remove 30% standard deduction, and therefore the number becomes 8,47,000. So this is going to be for the commercial units. I think this is fairly the answers. Let's check what is happening. 11,55,000 for residential unit and 8,47,000 for commercial unit. Yes, I think option A itself is the right answer. Yes, 11,55,000 for income from house property, 7,70,000. No, I don't see that number. 10,78,000 for residential unit and 8,47,000 for PGBP. No, this is not going to be PGBP, people, because I'm not in the business of letting out of properties. Look at question number 2. What would be the answer to MCQ number 1 if Mr. Manish is not a real estate developer and has a business of letting out of properties? Now, people, here is where the amendment comes into picture. The moment the amendment came in and clarified, even if you're in the business of letting out of properties, residential is always going to be under HP, commercial alone moves to PGBP. So I'm going to look for an answer when 11,55,000 still remains under HP, which becomes either option B or either option B or option D. Look at 11,55,000 and 11 under PGBP. Now we need to decide whether 8,47,000 is the one which is going under HP. No, 8,47,000 is also not going under HP, people. It is going to go under PGBP because commercial units can be taxable under PGBP. This automatically gives me the answer as option number D. Yes. Now, for those people who are focusing attention, if you notice, 11 lakh rupees is what is showing under PGBP. Why is that so? Understand, when it comes to house property has the condition of ER or AR, whichever is higher. PGBP has no such conditions. So, PGBP is going to be taxable for the same amount of income which the person has earned. The person has earned 20,000 rupees. So, 20,000 rupees will get multiplied for 5 units, will get multiplied for 11 months, and therefore the answer becomes 11 lakh, which is what you see in the answer. So, two things you have to keep in mind, people. When income is classified under PGBP, there is no ER or AR comparison, and second, there is no 30% standard deduction. So, the 11 lakh rupees will become fully taxable under your PGBP as a topic. So, option number D becomes my right answer. Clear? Great. What would be the tax treatment for the vacant properties? Now look at this carefully. What is happening is I have some properties of 15 and 10, whereas I'm only let out 10 and 5, which means there are some vacant properties. Income from house property as a chapter will come and say that when you have vacant properties, I give you time for 2 years from the end of the financial year in which the unit was ready by certificate of completion, after which they will start taxing it as income from house property. If I notice, my project was completed on 1st February 23. Year end would become 31st March 23. 2 more years will become 31st March 2025. So in financial year 24-25, do you have any implications? No. The income is going to be treated as nil because I don't have any such impulsions here. There is no problem here. No tax treatment as the unit were not let out and as held as stock in trade. 2 years have not lapsed from the financial year. Yes, option A looks right. Vacant units would be deemed to be let out for 2 months. No, definitely not. Vacant units would be deemed to let out for 2 months, Feb and March as expected rent. No. Vacant units would be into letter for 2 months. No, people, the only mistake you will end up making here is that the question will say 1st February. So which means you should not have the assumption that it's 2 years from the date of completion. It is 2 years from the end of the financial year in which the house is completed. So that alone you have to keep in mind. Next, which of the life policies would be exempt at the time of maturity proceeds? Let's read further on the case scenario questions. Mr. Manish is also engaged with the firm Zoho and Associates as a sleeping partner. Okay, so now we have a sleeping partner here. The firm has 3 partners. His capital in the firm is 10 lakh rupees. As a sleeping partner, what are you eligible for? You're only eligible for interest on capital. Each partner has received interest at the rate of 15% on the capital. Can a partner receive 15%? No. Even if you're a sleeping partner or a working partner, interest on capital has been restricted to 12%. And the remuneration of 30,000. 30,000 and all is definitely not coming to you. As a sleeping partner, what on earth are you getting remuneration for? Not allowed. Definitely not allowed. Interest and remuneration are authorized by the deed. Let it be. It doesn't matter. As a sleeping partner, I am not giving remuneration to you. So let's look at what is his capital. The capital is 10 lakh rupees. I am eligible for 12%, which means I am taxable for only 1,20,000 rupees as a partner. So that should become my answer here. 1,20,000 becomes my right answer. Yes, I'm not going to be taxing your book profits. I'm not going to be taxing your salaries. It doesn't matter because at the end of the day, you are a sleeping partner. Last thing on the LIC policies. He has taken 4 LIC policies. The details of such policies are given to you. Now, people, when it comes to LIC policies, there is some standard rules which I tell in the class. Rule number 1 is to always check for the limit of 10, 15 and 20%. If the policy is before 2012, I need to be paying a premium up to 20% on the policy for it to be exempt. If the policy is after 2012, then I should be paying 10% on the policy sum assured in order to be exempt. But if it's a handicapped person, I should be paying 15% from 2013. Keeping that in mind, let's do that first. If there itself something is taxable, then the policy is anyway taxable. If a policy becomes exempt, there is when comes the limit of 5 lakh rupees on an annual premium level. Yes, so let's keep that in mind before we go forward. Let's look at the date of issue. The first case is the date of issue of 2021. Now, the new amendments of the 5 lakh rupees premium is only applicable from 2023. So 2021 policy is anyway exempt to that extent. Let's keep that in mind. I have a premium of 4 lakh rupees which I've paid. The rate of which premium falls due is 1st April. The date of maturity is 2030. Consideration received on maturity is 40 lakh rupees, whereas the sum assured is 35 lakhs. Step number 1, people, when you have a sum assured, you can only pay maximum of 10% of the sum assured if the policy is taken after 2012. Looking at the sum assured is 35 lakhs, which means I should have only paid a premium of 10%, which is 3,50,000. But I've ended up paying a 4 lakh rupees worth of premium, which means policy number A is taxable. No doubts about it. Policy A is going to be taxable. Even if the policy was before 23, it is taxable because the 10% rule has been violated. Next, looking at 1st April 23, this premium was paid for 1,50,000 and I have a consideration of 20 lakh rupees on maturity, whereas the sum assured is 14 lakh rupees. For sum assured being 14 lakh rupees, I can pay up to 10%. So 1,40,000 is what I can pay. 1,40,000 is what I can pay. I have paid 1,50,000 worth of premium. Yes, so here is where I'll have a challenge. So let's keep that in mind. Next, I have 1st February 24. On 1st February 24, I've paid a policy of 2 lakh rupees. My sum assured is 22 lakh rupees. 22 lakhs into 10%, I am eligible for exemption because this is only 2 lakh rupees. I could have paid a premium up to 2,20,000. So this premium can be treated as an exempt component as of now. Next, when it comes to policy number D, my sum assured is 31 lakhs and I paid a premium of 3 lakhs. People, sum assured being 31 lakhs, I can pay up to 10% as a premium number. 31 lakhs ka 10% will become 3.1 lakhs. The person has only paid 3 lakhs and therefore that is also can be treated as exempt. Which means one thing is fairly clear. 2 policies are going to be exempt, 2 policies are going to be taxable. Now, exempt policies on a standalone basis should not go more than 5 lakhs. On a cumulative basis should not go more than 5 lakhs. Let's take the policies. Standalone basis is not going more than 5 lakhs. If I cumulate them also, it is not going more than 5 lakhs. So which means these policies can be treated as exempt. So I can treat LIC-C and LIC-D as exempt. LIC-A and LIC-B becomes taxable. Looking at the questions, which of the life insurance policies would be exempt has been requested, people. If it is exempt requested, the answer is LIC-C and LIC-D. Yes, so I think this is what you might have probably had a little bit of a challenge on, but this is what the answer is. So what are the rules, people? Step number 1, always come and check for the 10%, 15% and 20% premium. If that itself the policy is taxable, then there is no discussion forward. That is a taxable policy. If the policy is exempt on those lines, then I come and check for the premium of 5 lakh rupees. If the premium is up to 5 lakh rupees, I am exempt. If the premium goes more than 5 lakh rupees, I will have to end up taxing that. Are we clear? Yes, sweet. Keeping that in mind, I think we're done with the MCQs, people. Let's look at what kind of comprehensive questions ICAI had for us for the September 25 RTPs. Mr. Varun is an Indian citizen and is engaged in consulting business in India. I have an Indian citizen in my hand. He shifted to Dubai in the year 2019 to expand his consulting business overseas. Okay, so the person has left India in 2019. The person since then has been visiting India to supervise his office in Delhi. His stay in India for the current year as well as the past years are given to you. I have 95 days in that year, 105, 95, 75 and 100. Current year is more important. I have current year only 100 days in my scope. Yes, which means you have not satisfied more than 182 days condition in the current year. If you have not satisfied more than 182 days condition in the current year, you will have second condition to be checked for where you are visiting India. If you are visiting India, then I can come and ask you for your Indian income. If your Indian income is more than 15 lakhs, then I will check for a 120 days condition in the current year plus 365 in the past 4 years. This person has anyway been there for only 100 days, which means no matter how I look at it, this person is going to be a non-resident. Yes, this was very simple. During the previous year 24-25, he has earned the following income. My consultancy business in India, fully taxable. My consultancy business in Dubai, not taxable. Agriculture income from land situated in Kerala, exempt. Dividend from Indian company received in Dubai, Indian company itself makes it taxable. Interest expenditure on investment in above shares. People, you can only have a deduction worth of 20% on this. So let's check. 50,000 into 20% gives me 10,000 rupees. So I can claim a deduction of 10,000 rupees on this dividend expense. What else do I have? Yes, you're required to determine residential status, non-resident. Compute the total income of Arun. If he opts out of default tax regime, he is opting out. No, doesn't matter. Doesn't matter. I think that is what the answer is going to be, people. So I have 10 lakhs, 50,000 and then 10,000. So it's 10 lakh 40,000 worth of income, which is going to be taxable. Let's check if that is what I say is also aligned to residential status determination, the whole thing they have given to you. At the end of the day, the person has been told to have oh, is income set up from India? I'm sorry, did I miss that out? Oh, it just says income from consultancy business in Dubai. Where does it say that it's earning from India? That's weird. Okay, let's just check this. So he has 10, 4, agriculture is exempt, 14 lakh 40. Yeah, anyway, I think the person has come and told him that he's a non-resident, so it doesn't matter. Yes, people, there is one small mistake in this question. This 4 lakh rupees is definitely not to be taken, even if you were checking for your 15 lakh rupees condition, because at the end of the day, nowhere in the question does they mention that the Dubai business is being controlled from India. It was not mentioned like that, so definitely not to be taken. But nevertheless, 10 lakh 40,000 is what the answer is. That is what we have also got as a number. Yes, awesome. That is easy. Look at question number, what are we doing? We are doing question number 7. Question number 7 says you have an Aryan Mr. Resident individual has worked with Nischay Limited and has earned a salary of 90,000 rupees during the previous year 24-25. So I have a salary of 90,000 rupees. Let's check. 90,000 rupees into 12 is going to give me 10 lakh 80,000 rupees. The person is paying tax under default tax regime. With the default tax regime, I am eligible for 75,000 worth of deduction. Therefore, I am liable for a salary income of 10 lakh 05,000. That is going to be my taxable salaries. Next. He holds 20,000 equity shares of Alpha Limited, an Indian listed company purchased on 1st January 2016 at 200 rupees per share. Good enough. They were acquired during a recognized stock exchange and STT was paid both on sale and transfer. This is 112A. In August 2024, which is post 23rd July, Mr. Aryan has transferred a plot in Chandigarh for 70 lakh rupees, which was acquired by him in 2016 for 22 lakhs. He has a brokerage of 1% on transfer. People, transfer of immobile properties post 23rd July. We have done a format also. Post 23rd July, no indexation benefits. You can take it into consideration. If the question would have asked me for tax payable, then I would have checked for both old and new for the tax liability purposes. But from an income perspective, it doesn't matter. No indexation benefits are granted to you. In November 2024, Alpha Limited decided to buy back 50% of its shares at 2250 per share. So this looks like an amendment of the current year, people. When you have a buyback happening after October, if you have a buyback happening after October, then whatever buyback price which you receive will be fully taxable as income from other sources. The cost of acquisition of the shares will anyway become a taxable cost of acquisition, a capital loss for the purpose of capital gains. In May 2025, Aryan has acquired a residential house property in Kanpur for 40 lakhs. People, I have sold a plot of land and then transferred and bought a house. This will be section 54F. 54F exemption is going to come into picture. Fair market value of equity shares as on 31st January 2018 is given. Because it's 112A, we'll have to do that computation as well. You're required to compute the total income. I think this can be fairly answered, people. Let's quickly look at it. First thing, when I'm going to capital gains, I'm going to first find out what are my sale items. My sale items are going to be the sale of land. Yes, if I'm going to sell the land, what am I selling it for? I'm selling it at a price of rupees 70 lakhs, which was acquired for 22 lakhs. So 70 lakhs worth of price, but in that 70 lakhs, I also have 1% ka brokerage. So 70 lakhs, remove 1% brokerage, minus 22 lakhs will give me my number, which is 47.3 lakhs is my capital gains. Yes, so I remove my cost of acquisition, my capital gains is 47.3 lakhs. What is my net consideration in this question? My net consideration is going to be 70 minus 1%, which is 69.3. What is my cost of acquisition? My cost of acquisition is 22 lakhs. Clear? Yes, yes, good. In November 2024, Alpha Limited has decided to buy back 50% of the shares as 250 rupees. Now, people, this 250 rupees, 50% of the shares. So, how many shares did I have? I had 20,000 shares. 10,000 shares is what I'm going to buy back. So, 10,000 shares into 250 rupees is what I see as a number, which is 25 lakh. 25 lakh is directly going to go as my IFOS income. Yes, so I'm going to take 24 lakh as my IFOS income directly, no questions asked. But on the 20,000 shares, I am eligible for cost of acquisition as a capital loss. So how much do I have? So I have 10,000 worth of shares which are being bought back. 10,000 into 200 rupees per share is what they are going to buy back. Is what they're going to buy back, and therefore 20 lakh rupees is what is getting bought back. This 20 lakh rupees can be treated as a long-term capital loss. Can be treated as a long-term capital loss, so we can do that as well. Alpha Limited bought proportionate shares of Aryan in May 2025. Aryan has acquired a residential house property for 40 lakhs. Now, people, the rules of 54F will apply. If I would have transferred it at 69.3 lakhs, I would have got a complete exemption of the 47.3. Since I have not sold it for 69.3 lakhs, I will get only proportionate exemptions. So, I will take what? I will take 47.3 divided by 69.3 into 40 lakhs is what I bought for. So, which means 27.3 is what I can claim as an exemption. Yes, so 27.3 lakhs is what I can claim as an exemption. That leaves me with 20 lakh rupees, and the 20 lakh rupees will be set off against my capital loss, which means my taxable capital gains is going to be 0. I have one issue here. People, the long-term capital loss is actually wrong, because if you notice the long-term capital loss comes and says the fair market value is 190 lakhs. Yes, when it comes to 112A, 112A has a certain rule. When it comes to 112A, you have to take the sale price or the cost, you have to take the sale price or the FMV, whichever is lower, and compare it with the cost of acquisition, whichever is higher. Now, my sale price is going to become nil, because that's what the section comes and asks. My FMV is going to become 190 rupees, but taking that into consideration with my cost of acquisition of 200 looks like my cost of acquisition, therefore I'm still fine. Yes, my capital loss is not wrong, my capital loss is going to be right, which means my answer is going to be 10 lakh 5,000 rupees of salaries, nothing of capital gains, and 25 lakh rupees my IFOS. I'm not claiming any indexation benefits because nothing was done before 23rd July, everything was done after 23rd July. Yes, let's check. So 10 lakh 5,000 of my salaries, good enough. My, yes, nil will be my buyback, and 20 lakh rupees will be my cost of acquisition. So I get a long-term capital loss of 20 lakh rupees. I have my sale consideration, my brokerage becomes 69.3 lakhs. My cost of acquisition is 27 lakhs. So I have 47.30. Taking my exemption of 54F, I got the exemption as 2730 like we discussed. And therefore you have 19 lakh 99,000, which I rounded off to 20 lakh rupees. This 20 lakh rupees is got set off against my long-term capital loss, and therefore my net loss is 0. Yes, and there my dividend of 25 lakhs becomes fully taxable, thereby giving me my incomes. Good question, people, at least on the 54F piece. So you should be paying attention to this. What else are we looking at? Question number 8. Let's look at question number 8 very, very carefully. Question number 8 says, I have Mr. Suraj, age 40 years, and I submitted the following information for the year ended 31st March 2025. There is an income. What is the question asking for? The question is asking for the total income of Suraj, assuming Suraj's total income is higher than Mrs. Suraj's total income. Looks like a clubbing question. Suraj has exercised the option of shifting out of default regime. So Suraj is going for alternate tax regime. He is employed in ABC Limited, earns a salary income of 10 lakh 50 people. When he says earned and is computed, this is the final answer. This becomes my I income from salaries. This becomes my income from salary. No computation changes here. He's engaged in speculation and non-speculation businesses. He's earned a profit of speculation business 60,000 and a loss of non-speculation business 40. People, can a non-speculative loss be set off against speculative profits? Yes, definitely. You can make the set off. No problems here, which means 20,000 rupees will be taxable as my PGBP income. So I'm just going to note it down on the right side. I have 20,000 rupees worth of income being taxable under PGBP. Next, he reported a short-term capital gains of 80,000 rupees. He's also received a lottery winnings of 20,000 rupees gross. Okay, so I have my CG of 80,000 rupees. I have my IFOS, which is my winnings of 20,000 rupees gross level. He has a brought forward long-term capital loss of 30,000 from AY 23-24. People, a brought forward long-term capital loss, can you set off against capital gains of short-term? No. So this is getting carried forward. No permission to set off, carry forward. Mr. Suraj has two children, one married daughter Riya aged 17 years and a son Raj aged 16 years. Minor married daughter people. The interest income of Riya and Raj is 1,200 and 2,000 per annum respectively. Now interest income of Riya's and Raj's is given, which means these two things will be clubbed in the hands of Mr. Suraj because minor children's income is fully clubbed in the hands of parents. Now this person has opted out of default tax regime, which means I'm also eligible for your exemption of 1,500. So Raj's income is going to become fully exempt. My Riya's income of 2,000 rupees is going to become taxable in the hands of Suraj after an exemption of 1,500, and therefore 500 rupees is going to be taxable for Mr. Suraj. What else? He transferred a flat to Riya on 1st April 24 on account of natural love and affection. The flat was let out from that date and generated a rental income of 5,000 per month. People, deemed ownership concept comes and clarifies that when it is a transfer to minor married daughter, it is not taxable under that HP. It is going to be treated as per clubbing rules. It is going to be treated as per clubbing rules. So clubbing rules will apply here, people. 5,000 per month is what the rent is. So 5,000 into 12 is my answer. 60,000 rupees minus 30% standard deduction. Number comes to 42,000. So 42,000 is what is going to get clubbed in the hands of Mr. Suraj as per clubbing rules. Yes, they're going to be as per clubbing rules. At the end of the day, the factor is not going to change. The factor is not going to change because I've already used the 1,500 worth of exemption on the top line item. Therefore, it doesn't matter. But yes, 42,000 will be taxable under the head house property for Mr. Suraj. Suraj has taken a medical insurance premium of 22,000 during the financial year to ensure his health, his spouse and his dependent. 80D here, people. So 80D 22,000 can be claimed as a deduction. He's also paid 33,000 to ensure the health of his mother, who's age 67 years, who's not dependent on him. Eligible, definitely eligible. He's also incurred 20,000 as medical expenses for his father, aged 71 years, who's not dependent on him and is covered under insurance policy. People, 33 plus 20 will automatically become 53. I cannot claim the whole 53 as an exemption, so therefore I will remove this off and I will claim 50,000 worth of exemption. He has contributed 6,000 during the year to central government health scheme. People, the moment I contributed 6,000, it became 22 plus 6, so 28, but I can only claim a deduction of 25, so 25,000 gets deducted. So therefore, I get a ATD of 75,000 as a overall deduction. We're required to compare the total income. Yes, this is what the answer should be. So let's check if we have matched it properly. Where are we? Yes, salaries becomes 10 lakh 50, which is what we discussed. Speculative losses, non-speculative losses, speculative income got set off. So 20,000 is my income, good enough. Capital gains is 80,000 rupees to be reported as it is. Long-term capital loss will only get carried forward. Winnings gets reported as it is. Interest income of 1,200 of Riya is getting taxed. Wait, Riya was 1,200? I thought Riya was 2,000. Oh, respectively. I'm so sorry. Okay, I'm looking at this reverse. So interest income of Riya is 1,200. People, if Riya is 1,200, then 1,200 will be taken from here, and only 1,200 will be taken from here, and the balance exemption will be granted from the other side. Looking at Raj is going to be exempted for 1,500, and therefore Raj will be paying tax on Suraj will be paying tax on 500 for the Raj. On the 1,200 plus this 42,000 will be added together, and then an exemption of 1,500 will be granted on both, because both are under clubbing rules. So that is what is going to happen, people. Yes, so where am I? Yes, so 1,200 and then 1,500, 1,200 and then 42,000 and then your 1,500 worth of exemption. So that is what will happen for Riya. When it comes to Raj will get a taxable component of 500 rupees, which will be clubbed in the hands of Suraj because opting out of default tax regime. 75,000 worth of ATD has been claimed as reduction. That is what we discussed, and that's for the answer. That's for the answer. Very simple case, people, not much complicated. I think that leaves me with one more question. No, I have two more questions. You're required to examine the tax applicability and determine the tax deduction at source for 25-26 in the following situations. We're looking at TDS as a question. Nexus Private Limited is a company engaged in the business of manufacturing electronic goods and has reported a turnover of 12 crores. Looks like section 194Q, people. During the financial year 24-25, the company has made the following purchases. Yes, 194Q has been given as a question. Raw materials worth 60 lakh rupees, 25 lakh rupees in April and 35 lakh rupees in July. Payment of 20 lakh rupees was made in June and the remaining payment in September. Vendor has not furnished his PAN number. People, the moment the payment goes beyond 50 lakh rupees, you are liable for TDS at the rate of 0.1%. But unfortunately, because the person has not furnished his PAN number, you will have to do TDS at the rate of 1%. Yes, 1% TDS. Sorry, is it 1 or 5? Should be 5. Where am I? Where am I? Yes. Limit is exhausted. Yes, 5%. So 5% is what it is. Correct. So 5% is what we are doing on TDS, people. Next. Vendor B, trading goods worth 48 lakhs on installments, 15 lakhs in May, 13 entire payment was made in March, not exceeding 50 lakh rupees, therefore no TDS, this gets ignored. It is to be noted that Nexus Payment has made entries in the books and TDS provisions are not applicable. Yes, TCS is anyway not applicable, so forget it off. Jan 2025, Sumit is engaged in the business having turnover of 1.2 crores, more than 1 crore, so hijacker will apply. Enters into annual maintenance contract with ABC Limited and resident company for 5,40,000 plus GST of 18%. Sumit made the payment in February 2025. ABC Limited has not provided his PAN to Mr. Sumit. Now, people, the person who's receiving the money is a company and therefore hijacker was anyway applicable. This is a 194C case. Because it's a 194C case, I am liable for TDS at the rate of 2% because it is a company. But because the company has not provided their PAN number, TDS happens at the rate of 20% on the whole transaction amount. Yes, so deduct TDS at the rate of 20% and close it off. But note carefully, people, that the number is 5,40,000 plus GST of 18%. I am only deducting TDS on the 5,40,000. I am not deducting TDS on the GST component. Please don't do that. Next, I have Mr. Shobit, a resident individual aged 54 years and is engaged in manufacture of spare parts of cars. He has followed a mercantile system of accounting and is regularly filing his return. The profit and loss for the year ended 31st March 25 has been given with a net profit of 57,25,000. This is my starting point under the head PGBP. Clear? Yes. Let's check what the question requirement is. Oh wow, it's a very lengthy question. You're required to compute the total income of Shobit, also the tax payable after TDS and TCS credit, if any, for 25-26 if he is opting out of default tax regime. So now I have a person under ATR. Yes, keeping that in mind, look at the adjustments. During the year, Shobit has purchased a plant and machinery for 55 lakhs, which he took on loan from scheduled bank. Date of loan is 1st April 24. Rate of interest is 11%. Asset acquired on 1st July and asset put to use on 1st September. Entire amount is debited to profit and loss account. People, I have a problem here. Borrowing cost standard will come into picture because the asset was not put to use when the loan was taken. Till the date the asset is put to use will be capitalized. So let's check what is the period which I have to capitalize. I have a loan of how much? 55 lakhs. So I have a loan of 55 lakhs. That loan of 55 lakhs will be multiplied with 11%. Yes, but notice carefully that I have to take a period of what? I have to take the period of April. No, it's the loan is from May. So it is May, June, July, August. Yes, so 4 months will be taken into consideration. So it is into 4 divided by 12. Therefore, 2,01,666 will get disallowed. Yes, so that is what is going to get disallowed. I'm just checking this once again. I have 55 lakhs into 11% into 4 divided by 12. Therefore, the answer is 2,01,666. Yes, so I've taken it for May, June, July, August. Yeah, so 4 months is what is going to happen. These interest will get fully disallowed and will be capitalized to the asset cost. So this has to be disallowed in PGBP and then has to be capitalized to the asset cost to claim depreciation. Yes, next. On 1st April 24, the production manager working in the factory of Mr. Shobit took voluntary retirement from the services. Shobit has paid 8 lakh rupees as compensation for his VRS scheme and the whole amount is debited to P&L account. People disallow the whole 8 lakh rupees because VRS scheme can be claimed as deduction for the next 5 years. So I will disallow 8 lakhs and I will claim 1/5 of it, which means I can claim 1,60,000 as a deduction. Next, Mr. Shobit has purchased raw material from Kamal and Sons, a micro enterprise, and Hitesh and Sons, a medium enterprise, for 51,000 and 75,000 respectively on 15th March 2025. Return agreement has been signed up where the person has to make the payment by 10th April. Mr. Shobit has made the payment to Kamal and Sons on 9th April, so which means within time, so no problem on the 51,000, and to Hitesh on 15th November 25. Will I see a problem here? No. No problem here as well, people, because the person is a medium enterprise. Yes, I don't have a problem on medium enterprises. I only have a problem on micro and small enterprise. So micro and small payments, if they are delayed, will get disallowed, but a medium enterprise payment will not get disallowed. Has no impact on this question. Conversation over. He has paid 20% of the basic salary to the account of each employee under a pension scheme referred to in 80CCD, which is debited to profit and loss account. The basic salary of the employees aggregate to 10% and the DNS allowance is 40%, which is forming part of retirement benefits. Now, people, the amendment of the current year when it comes to NPS scheme, an employer can contribute up to 14% of the salary plus DA forming part as a part of the discussion. So I have 10 lakh rupees plus 40% of this number. So therefore 14 lakh rupees is what I have per salary employees. Do I have how many employees in this question? They have not mentioned any employees, right? I don't see any employees count. Yeah. Question does not mention the employee count, which means I'm assuming only one employee then. Yes, let me assume only one employee. Now 14 lakh rupees is what is the total eligible salary. On this 14 lakhs, I could have given a percentage of 1.96. So 1,96,000 is what I could have paid as NPS contribution. I have 10 lakh rupees into how much have I paid? 20% is what I have paid, and therefore 0.04 will get disallowed. 0.04 will get disallowed here. So 0.04 lakhs is what is going to get disallowed for the purpose of the computation. Yes, so that is what is happening. Depreciation debited to P&L account directly disallowed because PGBP will be done separately as per section 32. He has received 13,850 as income tax refund. Out of his 3,850 is on interest on refund. The entire amount is credited to P&L account. Because the entire amount is there, people, I'm first going to remove the entire amount from my P&L. Separately, I'm going to be taxing the rupees 3,850, which is my interest on income tax refund under the head IFOS. Yes, so remove 13,850 from PGBP and add the 3,850 under your IFOS head. Mr. Shobit has purchased a new computer on 31st August 2024 and was put to use on the same day in the office. The payment was made as under 28,000 was paid in cash at the time of purchase of new computer on 31st August. Problem. Cannot make payments more than 10,000 in cash. Not allowed for depreciation purposes. 25,000 was paid by account pay check on 5th September as balance of new cost computer. This is eligible for deduction. So take this 25,000 multiplied with 40% is what I can claim as a deduction. Why? Because people, the asset was put to use on 31st August. Since it is put to use before 2nd October, I am eligible for 40% full depreciation on this. WDB as per Income Tax Act of different assets are given to you. The plant and machinery is 8 lakh rupees. The factory building is 6,45,000. I can claim on plant and machinery 15%. I can claim on factory building 10%. At this point, people, I need to pay attention to my asset above. I have an asset which is purchased on 55 lakhs, which he took the loan. The asset was acquired. The entire interest amount is debited, which means this is not part of the question given in the bottom. The additional information does not have it. This 55 lakhs has to be separately taken into consideration. So it is 55 lakhs plus 2 lakh 1,666 to also be multiplied by 15% because the asset was put to use on 1st September. This is not given an additional information, people, and the catch point is here. Question says they've only given you WDVS on 1st April, which means all assets happening in the middle of the year has to be taken separately into consideration. He has paid 50,000 rupees as life insurance premium on the life of his father who's dependent on him. The sum assured is 8 lakh and the policy was taken on 1st April 2015. People, you cannot take any life insurance on your parents. Not allowed. You can only take medical insurance on your parents. Not permitted. Not eligible. He's paid 45,000 as life insurance premium taken the life of his married daughter who is not dependent on him. The sum assured is 5 lakhs. The policy was taken in 2017. Whether the child is dependent or not dependent doesn't matter. Child deductions are eligible. So sum assured is 5 lakhs. I could have paid 50,000. I have paid only 45,000. So I get 80C. Yes. So 80C eligible for deduction. On 1st 10/2024, he withdrew 1.5 crores in cash from 2 current accounts maintained by him in PN banks. There are no other withdrawals during the year. Now, he has withdrawn 1.5 crores in cash from 2 current accounts maintained by him in PNB bank. There are no other withdrawals during the year. Now, I have a question. 1.5 crores each or 1.5 crores together? Assuming it is each. Assuming it is together actually. Let's assume it is together because it says from 2 current accounts of the BNB bank. So, which means it's the same bank, people. Therefore, I would rather assume that it is it is together only. In that case, 1 crore is what is eligible for non-deduction of TDS. The balance 50 lakhs will be liable for TDS at the rate of 2% because the person has been filing his returns properly. Yes, so this is a TDS credit which I will get. So 2% of 50 lakh rupees is what I can claim as TDS credits. Next, Mr. Shobit has sold a house for 30th March on 30th March 2022 and deposited long-term capital gains of 25 lakhs in capital gains account savings scheme by the due date of return filing of that year. Okay, so 54 exemption claimed in that year. On 1st July 2024, he sold another house property in which he resided for 1 crore. Okay. He earned a long-term capital gain without indexation benefit of 50 lakh rupees on the sale of this property. Good enough. On 5th January 2025. So let's see what is the period happening. I have, is that purchase? Construction. Okay, so if it's construction, people have 3 years timeline, which means after 30th March, I have timelines of 3 years. 3 years would become, what is the timeline? When did I sell the house? On 30th March 22. So it is 30th March 25. I have timeline till 30th March 25 in order to buy a new house. The person has withdrawn the money on 5th January 25, which is within time limits. He has withdrawn the whole money out of his capital account and invested 60 lakhs on the construction of a house in Mumbai. The construction of the house completed on 23rd March 25, which means the construction is completed within 3 years, no problem at all. Index cost of acquisition of the house property is 60 lakhs. Which house property are they talking about here? Which house property? Oh, the 1st July property. Okay, fine. So people, let's understand this carefully. I have invested 60 lakh rupees in the new house property. In that 60 lakh rupees, 25 lakh rupees became exempt because of that logic. Yes. So I cannot take that as a consideration once again. So out of 60 lakh, 25 is gone. 60 minus 25 gives me the answer as 35. So 35 is what I can claim as an exemption for the current house. Now in the current house, what have I sold the house for? I have sold the house for 1 crore rupees. In that 1 crore rupees, I have got a long-term capital gain of 50 lakh rupees, which means my cost of acquisition here was 50 lakhs. So let's understand this carefully. My full value of consideration is 1 crore. My normal cost of acquisition is going to be 50 lakh rupees, and therefore my taxable capital gain is 50 lakhs. Correct? So this is what has happened. This is what has happened. But on this 50 lakhs, I am now eligible for an exemption of 35 lakh rupees, and therefore my taxable capital gain is 15 lakh rupees. Yes, this taxable capital gain will be taxed at the rate of 12.5% in the current year because the question says without indexation benefits. So this property, but why did the person, no, 1 second. On 1st July 24, he sold another property. 1st July 24 is before 23rd July. So why have they given this information to you? This is kind of wrong, right? Yeah, I'm going to ignore this, people. I think this is just confusing you. They've come and told they have earned a long-term capital gain of 50 lakh rupees on sale of this property. It doesn't matter because the property is before 23rd July. I was anyway not going to claim 50 lakh rupees as my cost of acquisition. My cost of acquisition here should be 60 lakh rupees. Yes, so with that 60 lakh rupees cost of acquisition, 40 lakh rupees is my capital gain, 35 lakh rupees is what I can claim as an exemption, and therefore 5 lakh rupees will be my taxable long-term capital gain. On this 5 lakh rupees of taxable long-term capital gain, I'll be paying tax at the rate of 20%. Yes, so 20% is what my taxable long-term capital gain would be. I had no reason. Why did they give me a long-term capital gain without indexation benefit? No relevance here. Yes, absolutely no relevance here because it is not even booked in the P&L account. What does it matter? Yeah, weird question. The next thing which is to be kept in mind, people, and this is something which most of the students will not pay attention to, is that because the person has sold a house property, the other person who's making the payment to this guy, would be deducting TDS under section 194IA. Yes, so he would be deducting TDS under section 194IA at the rate of 1%. So the 1 crore payment which you have received on that 1% has been deducted as TDS for you. So because it has been deducted as TDS for you, that is also a TDS credit which you need to take into consideration. So that would have been an additional item which they would have done in the question. So that is what should have happened. Let's look at the question answer now. Let's see what is happening. So I started from income from business 5725, like I said. Depreciation has been disallowed. We discussed about this. The interest on loan 2,01,667, like I discussed, people, will be disallowed for you because it is borrowing cost. 1/5 of it is getting disallowed because 8 lakhs was disallowed and then 1,40,000 was allowed, and 1,60,000 was allowed, and therefore 6,40,000 net is disallowed. Kamal is not disallowed because payment made on time. The other person is also not disallowed because it was a medium enterprise. Excess contribution of 4,000 rupees, like I said, people, 0.04 lakhs is being disallowed because of contributions. What else? My 13,850 is being reduced because I have to tax it under IFRS. So 3,850 is going to be taxed under IFRS. Factory building of 64,500 being taxed at being depreciated at 10%. Plant and machinery at 15%. The computer being acquired for 25,000 is only being allowed for a depreciation of 10,000 rupees because I can only claim depreciation on the 25,000 into 40%. The balance asset is not eligible for depreciation. The plant and machinery, like we discussed, we have 55 lakhs plus 2 lakh 1,000 will be depreciated at the rate of 15%. So that has been done. I have additional depreciation also in the question, people, because this was a manufacturing entity. Yes, it was a manufacturing entity. Where is it? Where is it? Where is it? Is engaged in the manufacture of spare parts. So I get a manufacturing benefit also. Now on the computer, people, they have not mentioned. They have mentioned that it is used in his office premises. Because it is used in his office premises, no additional depreciation on the computer has been given to you. Clear? What else? What else? What else? What else? What else? Plant and machinery is done. Yeah, capital gains of 1 crore, 60 lakhs index cost of acquisition, 40 lakhs. This is what I was telling people. I don't know why they gave you that 50 lakh rupees, non-relevant information. 35 lakh rupees has been claimed as exemption because the balance 25 lakhs has been gone for the exemption of the previous house. The 5 lakh rupees of capital gains is what is going to be taxed in the current year at the rate of 20%. 38505 is income. My deduction of ATC will not be eligible for my father because father is not under life insurance policies. 45,000 for my daughter is eligible, and that will be taken into consideration. So my total income comes to 75 lakh 75,580. People notice I'm an individual more than 50 lakhs worth of income, so I'm liable for a surcharge. Yes, so I'm liable for a surcharge as well. Now 20% will be taxed on the 5 lakh rupees. People, I don't have new amendment conditions of post 23rd July because as it was transferred before 23rd July. So directly take the income tax at 20%. The balance incomes are being taxed as it is. I have a 10% surcharge happening on this, and therefore that gives me an answer of 2238. Adding cess on this at 89. I have a tax liability of this. TDS has been done at 2% on 50 lakhs, so only 1 lakh rupees has been done. Now ideally, if you come and ask me, because the person sold a house property, there should have been a 194 IA also. They should have given you an 194 IA. So I would suggest in exam, if you get a question like that, always make an assumption. Make an assumption that the 194 IA is also taken into consideration and should be given as a TDS credit to you. While this question does not have it, you are supposed to have a 194 IA because otherwise the other person would be a defaulter. Yes, so you can also reduce 194 IA worth of 1 lakh rupees as a TDS credit as well for the purpose of computing the taxable component for your syllabus. Clear? Yes, great. This is what your RTP looks like for September 2025 exams. If you come and ask me, question number 9 and question number 10 were really nice. They had some adjustments which you would have not thought about normally, but it tests you a lot of amendment adjustments as well. So yes, please pay attention to these questions. Practice it once from your end as well and see if you're able to grasp these questions properly before you start preparing well again for your September exams. I would also like to take this opportunity to tell you people that as I'm shooting this video, I know that the mock test paper series number 1 has also been launched by ICA. So for everyone who's planning for your September exams, if you have not already subscribed for any test series, if you have not already done any other test, if you're not planning to, go for any other academy to write some test, or if your academy is not conducting any test, please use this opportunity, go to the ICA Institute and write all the mock test papers. Mock test paper number 1, mock test paper number 2, please write them mandatory. It is not about you coming and telling whether the paper is coming from past exams or not. It is more about you taking out the fear from yourself. Yes, the problem with most of the students is at this stage, they have already lost touch to their writing practice and are not equipped enough to see the exam atmosphere properly because it's already been about 10 to 12 months, and therefore you going to the exam premises, writing the exam with ICI would give you that nick of understanding how the paper patterns are, how ICI treats you, and what is the kind of exam pressure you're going to go through before the day of your exams. So if you don't already have a test series going on for you, please choose to go and write the ICI exams, at least one of the 2 mock test paper series, so that you can get a grip on how you should be preparing for your exams properly. That's it, people. I hope you all had a great time along with this. If you are already having any other suggestions on any other topics, any other discussions, any other insights you want to get from me on the taxation paper, please feel free to drop it in on the comment section, and I will try my best to make a video as soon as possible on those topics as well, so that you can use this as a reference point for your exams. Until such time, I hope you all have a great learning journey ahead. I will see you all very soon after you clear your CA inter exams and come back with the very happy news that you are going to become a CA finalist very soon. Take care. Bye bye.